Hello students, today we'll start with a new chapter, Admission of Partner under Reconstitution of Partnership. So what's Reconstitution of Partnership? It refers to change in the form of partnership, a change in agreement, a change in the relationship between partners. These changes may take place when the existing partner decide to change their profit sharing ratio, when a new partner joins in, when an existing partner retires, or due to the death of any partner. Now first, we'll start with admission of partner. A new partner will be admitted in the firm only when all the existing partners agree to it. Now, this new partner may be admitted so as to get additional capital for the expansion of the business activities, or this new partner may have some skill which the firm requires. When this new partner is admitted, he has to bring in a certain amount of capital as per the terms and conditions laid down in the partnership deed. He can bring in the capital in cash or in kind. If the partner brings the capital in cash, then we have to pass the following entry, that is cash or bank account debit to new partner's capital account. And if the partner brings in any asset other than cash as his capital, then we have to write asset account debit to new partner's capital account. Along with the capital, the new partner also needs to contribute towards goodwill. You see, the old partners are the ones who have struggled to earn the name and fame for this business. It is due to this reputation that the firm enjoys profit. When the new partner joins in, he will start getting his share of profit in the existing business. So, at the time of admission, unlike other assets, goodwill is valued and treated separately. Now, let's see some of the changes in ratios. Let's say, for example, in AB and company, A and B are partners sharing profit and losses equally. That is in the ratio of 1:1. Now, if there's a profit of rupees 9,000, then these partners will divide 9,000 equally among them, each getting a share of rupees 4,500. Now, if they admit a new partner into this firm, ABC and company, wherein A, B and C share profit and losses equally, so the ratio will be 1:1:1. Now, if they earn a profit of 9,000 and we distribute this profit, then each partner will get a share of rupees 3,000. Now, here you see A was getting a share of 4,500. But after admission, A is getting a share of rupees 3,000. Same in the case of B. A has sacrificed 1,500 from his share and B has sacrificed rupees 1,500 to give C his share of rupees 3,000. This sacrifice is in the ratio of 1:1, the ratio in which the old partners have sacrificed their share in the profit to give a share to the new partner is termed as sacrifice ratio. And the ratio in which the old partners were sharing their profit and losses earlier was their old ratio, and the ratio in which all the three partners will now share their profits is the new ratio. Now, sometimes in the question, all these three ratios will not be given. You may have to calculate the new ratio or the sacrifice ratio. Calculation of new profit sharing ratio. Anil and Sunil are sharing profit and losses in the ratio of 3:2. They admitted Janil for 1/4 share in future profit. The new profit sharing ratio will be calculated as under. The old ratio in which Anil and Sunil are sharing the profit and losses is 3:2. The new partner is admitted for 1/4 share. First, we have to find out the balance of 1. So from that entire 1 share, after deducting the share of the new partner, what is the balance? We get 3/4 as the balance share. Now we have to calculate the new ratio as old ratio multiplied by balance of this 1. So for Anil and Sunil, old ratio multiplied by balance of 1, we get 9/20 and 6/20. And when we convert the new partner's share proportionately, we get 5/20. So our new profit sharing ratio is 9:6:5. The calculation of sacrificing ratio. Mohan and Sohan are sharing profit and losses in the ratio of 3:2. Rohan is admitted as new partner. The new profit sharing ratio is 5:3:2. Now here the old ratio is given and the new ratio is given. We have to calculate sacrifice ratio. The formula for calculating sacrifice ratio is old ratio minus new ratio. The old ratio of Mohan and Sohan is 3:2. The new ratio 5:3:2. We calculate the sacrifice ratio of Mohan and Sohan. For Mohan, the old ratio 3/5 minus the new ratio 5/10. Here, the denominators are not equal. So we equalize the denominators and then subtract. We get 1/10. For Sohan, old ratio 2/5 minus the new ratio, we get 1/10. So the sacrifice ratio is 1:1. Sacrifice ratio is used to record entries for goodwill under premium method in case the goodwill is retained. Now let's come back to goodwill. Goodwill is an important adjustment in this chapter, so you need to understand it thoroughly well. Sometimes in your question, the value of goodwill will not be given and you have to calculate this value. There are various methods of valuation of goodwill. We have to value goodwill under these two methods, average profit method and super profit method. Goodwill is calculated on the basis of past performances. First method of valuation of goodwill, average profit method. The first step is to calculate total profit. To calculate the total profit, we have to add the profits of the previous year and deduct losses if any. Then we calculate the average profit, that is total profit upon number of years. And last, we arrive at the value of goodwill by multiplying the average profit by the number of years purchased that will be given in your problem. Let's understand this with the help of an example. So the 4 years profits are given wherein there's a loss of 10,000 in one of the years. So your total profit comes to 1,60,000. Then we calculate the average profit, that is 40,000, and then goodwill is equal to 40,000 multiplied by 2 years purchase, that is 80,000. Now the second method of valuation of goodwill is super profit method. Now what is super profit? If a firm earns extra profit over and above the normal standard profit, then this extra profit is called as super profit. Goodwill is calculated on the basis of this super profit. The first step, calculate the average profit. And the second step is to calculate the normal profit. The normal profit is equal to capital employed into NRR upon 100. Capital employed is the amount of capital invested in the firm to run the business. The normal profit is the profit earned by the firm in the same industry. For example, if the partners are carrying a construction business, then what is the standard profit that is earned in the construction industry? And NRR is the normal rate of return, the rate of this standard profit normally expected. Then we have to calculate the super profit, that is your actual average profit of the firm minus the normal profit. Then we calculate the goodwill as super profit multiplied by number of years purchase, which will be given in the problem. Let's understand this with the help of an example. The profits of the last 5 years are given. So we calculate average profit, which comes to 60,000. Then the normal profit calculated at the rate of 10% on 4,50,000, which is a capital employed. The normal profit is 45,000. Your actual average profit which the firm is earning is 60,000, and the normal profit which is expected is 45,000. So here there is an extra profit of 15,000, which is termed as super profit. So goodwill will be valued at 15,000 multiplied by 3 years purchase, that comes to 45,000. We saw the two methods how to calculate the value of goodwill, that is the average profit method and super profit method. Now let's see how this goodwill is to be recorded in the books of accounts and the two methods, that is premium method and valuation method. You have to see whether the goodwill is brought in cash by the new partner or whether it is raised in the books. Accordingly, you have to pass entries. The first method, premium method, the new partner brings his share of goodwill in cash or kind. Now this goodwill which is brought in cash by the new partner may be retained in the business, or it may be withdrawn by the old partners, or may be paid to the old partners privately. We have to pass entries accordingly. Here, when the new partner brings cash as his share of goodwill, cash is coming in. So we have to debit cash a bank account and credit goodwill account. So our first entry, cash a bank account debit to goodwill. This amount of goodwill will be credited to the old partner's capital account. So the entry for this is goodwill account debit to the old partner's capital account. In the second case, when the partner brings his share of goodwill in cash and this is withdrawn by the old partners, the first two entries will be the same. Here we have to pass one additional entry for the amount withdrawn by old partners. Old partners capital account debit to cash a bank. The old partners may withdraw the entire amount or a part of it. We have to debit the actual amount withdrawn by the partners. The third case, when the new partner brings his share of goodwill in cash and it is paid to the old partners privately. Here, no entry is to be posted in the books of firm. The second method is valuation method. Here, the value of goodwill is raised in the books of firm. We'll see the entries when goodwill is raised in the books of firm, when it is raised and written off, and what is to be done when goodwill already appears in the balance sheet. In the first case, when goodwill is raised in the books of firm, we have to pass an entry as goodwill account debit to old partners capital account in the old ratio. In this case, this amount of goodwill will be shown on the asset side of the new balance sheet. Now when the goodwill is raised and written off, the first entry is the same. We have to pass a second entry to write off this goodwill. So that entry is all partners capital account debit in new profit sharing ratio and goodwill account credit. Now here, this amount of goodwill will not appear in the balance sheet on the asset side. In the third case, when goodwill appears in the books of the firm in balance sheet, you have to see whether the goodwill is revalued or whether the new partner brings goodwill in cash. If the goodwill is revalued, we have to find out the difference between the revalued amount and the book value which appears in the balance sheet. This difference will be transferred to old partner's capital account or revaluation account. But if the value of goodwill appears in the balance sheet and also the new partner brings goodwill in cash, then first we have to write off the goodwill that is appearing in the balance sheet among the old partners in their old profit sharing ratio. And then we have to pass entries for goodwill brought in cash. That's all for today. Thank you.